Hello, everybody. Welcome to the Alternative Investing Club. Today is May 17th, 2024, and we are here with Paul Shannon. This club actually voted. First of all, we're now streaming live on YouTube. So hello to everybody out there on YouTube. A couple of months ago, this club actually voted and asked to not only bring in, and YouTube is yelling in my ears. This club voted to not only do a live meeting where we have educational talks, but to also bring in pitch talks. And today is going to be one of those days where we're going to get to hear an investment presentation. I hope everybody, has lots of questions and they put those into the chat. In addition to that, I also wanted to say that we are kicking off for the Alternative Investing Club a attendee referral program called the Share the Show or Share the Club program. And if you are interested in looking at that, I am going to drop a link into the chat. But basically, as a club, our ability to attract top quality speakers really depends on growing the club. And so we've gamified it a little bit. There's a cash flow navigator series of ranks that you can work your way through, starting at being a recruit, going all the way to an admiral. And you get prizes along the way. With the Admiral Prize for the top two people who make it there first, will get a paid stay at a short-term rental of their choice. So there's good prizes along the way, including an ebook that has all of the previous speakers' profiles and an outline of their talk. So it's over 180 talks outlined for you. And if you have gotten a lot of value out of this club, I would just ask that you would click on the link that I'm about to drop into the box and share it with just 3 friends. If you share it with 3 friends, this club will grow and we'll be able to attract top quality speakers. I know the club attendance has been down. A year ago, it was 100, 150 people, and now we're more in the 70 range, and I'd like to push that back up. So please join the program. You can, let me share my screen. When you do, you'll land on a page that looks like, looks like this. What you'll do first is you'll just join Referral Rock. It'll put you into the AIC Share the Club program. The program will allow you to, here it is. The program will allow you to share via various social media as well as email. So if you've got value from this group, we ask that you just share the club. Thank you. And I'll drop that into the chat right now, and I will let Paul Shannon and his group take over from here. Welcome to the Alternative Investing Club.
Thank you very much, Daniel. Appreciate the opportunity to be here in front of everybody today. Can I take over screen sharing rights?
Yes, go ahead.
Okay. If I could get this to get out of my way here so I could start the slideshow. There we go. Okay. Thanks again, everybody, for allowing us to be here today. We're joined by our partner, Spectre Capital, with Brad McGill here, who I'll introduce shortly. First, I'd like to introduce our team. We are Investwise Collective, and this is the management team of Investwise. Pat Wills and Ryan Stieg are on the call today. I'm going to keep the introduction short so we can get to the bulk of the content, but Investwise Collective is an affiliate of the Left Field Investors. I see that we have some of the Left Field Investors here today, which is excellent. Welcome, everybody. Left Field has a lot of synergies, I'm guessing, between the Alternative Investment Club and Left Field, and that we're a bunch of individuals that are looking to place capital in alternative investments, limited partners ourselves. We oftentimes pool together capital to get better terms from sponsors or better access. And that's how Investwise Collective was really born, was to bring curated deal flow to our group. And we're not registered investment advisors, but the 3 of us do this full time. We've invested our own personal capital in over 100 limited partner positions in passive investing deals. I'm an active participant in real estate as well. I reposition multifamily as well as single family locally here in Indiana in the Midwest. But we, obviously, I guess we saw an opportunity in the marketplace really to get better terms for sponsors. We noticed that it was more difficult to raise capital with what's happened over the last couple of years in the space, where distributions are being paused and essentially sentiment is down. And I'm sure everybody's well aware of that. So we thought that if we could come together as a team and write larger checks, we would give the sponsors some incentive to provide us better terms. And in the process, with us doing this full time, we could find the right deals for our group. I think my slideshow is going forward without my permission here. There we go. So Investwise Collective, we are a fund of funds, established experience in that we've, through the left field investors, raised about $30 million over the last 3 years. But we are ourselves a newer fund. We were formed in the summer of 2023. This will be our third deal. We've been very slow to come out with deals. We've been looking aggressively into all different asset classes within real estate, equity and debt, but we found it difficult to find solid risk-adjusted returns in today's market. And I'll explain a little bit more about that in a bit. But we also invest in debt, and that's what we're going to talk about today with Spectra Capital and Spectra's fund, the Spectra Velocity Fund. You see our duration as far as our appetite and then our targeted returns. Our value proposition, as I kind of mentioned, was either better terms or better access. And on equity deals, better terms might mean better preferred return. Maybe it's a 8 instead of a 7, or a better promote split. Maybe it's a 80-20 instead of a 70-30. And through that, we can monetize our fund, but ideally pass along better terms to our investors as well. And we consider our investors the fourth manager, quote unquote. The three of us will invest our personal capital in every deal that we go into. But we're a customizable fund. So we allow the investors that are in our fund to choose which deals within the fund they decide to go into. A little bit different than like a blind pool fund or a semi-blind pool fund, where you would wire a check, you would buy into the thesis of the sponsor and their buy box, and then they would go out shopping for whatever fit within that buy box, and you would be basically diversified amongst whatever assets they collected. In a customizable fund, because we are asset agnostic, we want to make sure that we're aligning our risk tolerance and being fiduciaries, but also allowing our investors to kind of pick and choose what makes sense for them based on their risk profile. So for example, in a couple of years, we may have 10 deals in our fund, but maybe there's a cash flow investor that really doesn't like development deals, and we've gotten into 2 development deals theoretically. They would be in the 8 deals that they liked, and they would skip those 2 development deals. With the customizable fund, they would get a single K1 at tax time that would be representative of just those 8 deals that they're in, and all their reporting, updates on the actual investment would be just related to the deals that they're in. So we like that structure because it really gives a lot more flexibility to our investors to allow them to choose which investments they get into. So where are we at today? We've been looking for equity deals, as I mentioned, but what we found is that there's still quite a wide bid and ask spread between what sellers are willing to part ways on for their assets and what buyers are willing to transact at. So transaction volume has been very, very low. And from what we have seen out there that is getting done as far as deals, they've been pretty aggressive. The underwriting that we've seen has been built on aggressive rent growth assumptions, aggressive terminal cap rates, and this makes the pro forma look pretty good. But reality is a different story sometimes, and we have pretty low risks overall, risk tolerance overall. So along with that, the going in cash flow is pretty low. We feel sometimes like these bigger groups that are out there raising equity today are doing so because they have to feed the machine they've created, the beast. They have these acquisition fees that then can cover their overhead, and they can continually feed the company that they've built. So we look at this as investing and not entrepreneurialism. So we want to stay away from that mentality. We really just want to find solid risk-adjusted returns and target those asymmetric risk return profiles. So from that standpoint, if you're a limited partner, we feel that moving down the capital stack makes a ton of sense in today's macro environment. And just as a refresher, the capital stack is the underlying structure of a commercial real estate deal. The bottom of the stack gets paid first, i.e. the lender, and the lender is the first capital in and the last capital out. So that means that in order for investors to turn a profit, the investment must make enough to pay back the lender before any excess profits can be realized by equity investors. So this means that the higher you're in the capital stack, the higher the risk and the higher the returns must be for you to make any money. So with that said, common equity holders were exposed to a lot of risk over the last couple of years. Deals where assets were bought high on the front end based on future cash flows with models built around aggressive assumptions while using aggressive debt. And while debt has gotten a little bit more conservative, really because it's had to, because of the lending environment we're in today, we're now seeing some of these deals that were done in the past, pausing distributions, getting capital calls, foreclosing. So we feel strongly that we're not quite over the hump yet. We're not seeing the kind of deal flow on the equity deals that would make us really excited to get illiquid for 5 to 7 years. So one strategy to mitigate risk exposure, but to keep capital in motion, is to allocate a portion of your portfolio in investments that sit lower in the capital stack. And that's really why we like debt instruments today, or private credit, private capital, private debt, whatever you want to refer to it as. I'll be introducing Brad here in a second, but this is first position collateralized real estate debt. It's low loan to values. Last dollar exposure is at 75% loan to value. So theoretically, the property could drop in value by 25%, and our investment dollars are still protected. We've got an experienced team with Spectra, and we've got semi-liquidity in that there's no lockup period. There is a penalty for the first year if you try to pull funds out before that, but after that, funds can be redeemed on a quarterly basis, which I find really attractive because at the moment there is signals that the real estate market is on the upswing again, and we're starting a new cycle. We can pull our money back out of these types of deals and rotate them into something more aggressive instead of being locked into deals that are marginal that we get in today. So with that too, there's, the lending market has really pulled back. There's not a lot of supply as far as lenders are concerned, especially for some of the, bridge type products, gap funding, et cetera. So with low supply and also high demand from borrowers, that creates pricing power. And pricing power comes in this realm in the form of high interest rates. So we as investors can capitalize on that and earn equity-like returns, but sit lower in the capital stack with collateral, et cetera, et cetera. So at this point, I want to stop jabbing here and I want to introduce Brad McGill. Brad has spent 25 years as a key innovator in finance, working in both capital markets and insurance. He's been involved for the last 5 years in developing and commercializing unique insurance coverages that manage financial risk on behalf of lenders and investors. Brad was founder and CEO of a company that played a key role in developing new financial products for the institutional capital markets, as well as serving as chief investment officer and portfolio manager of an alternative asset management company. Products developed by Brad and his company include derivatives on both commercial and residential real estate asset values, along with related custom benchmark indices, unique interest rate derivative products based upon the first exclusive license to LIBOR ever granted by the BBA. Brad, welcome. Brad has been a great partner for us at Investwise Collective. This is our second tranche investment we're raising capital for. The first tranche has gone extremely well. Our investors are very pleased. I'll turn it over to you from here, Brad. Thank you.
Great. Thank you so much, Paul, for the kind invitation. And Daniel, thanks to you and your group for inviting me to present today. Very pleased to have an opportunity to visit with you. As Paul mentioned, his organization, Investwise, began with us early on, was actually one of our first institutional investors just several months after we launched a little bit over a year ago. We're grateful for that early show of support and have now worked together for 8 months very successfully, and we value the Investwise relationship and look forward to continuing to expand it. I'll be happy to give you an overview of Spectra Capital and discuss our strategy and our fund in more detail. And feel free to let us know as we go along if you have any questions. We'll go ahead and talk about the overview here. Thank you. Yeah, a quick summary, and I think for this audience in particular, a little bit of background might be useful. Spectra came about, we formed the company about 1.5 years ago because our CEO and really the founding force behind Spectra, named Chris Bruner, we'll show you a bio here in a little bit, Very interesting person. He's a talented entrepreneur, has started 5 different technology companies of different iterations, including data management and digital marketing and SEO. Gifted technologist as well as a business builder. He sold his last company, a telecommunications data company, to a division of a Fortune 500 company in a very nice exit a few years ago. Received a substantial amount of liquidity upon that exit and began almost immediately receiving inquiries from people. As often happens, once people know you have money, they find ways to try to get some of your money. Folks in his extended network who are in real estate projects started calling him saying, "Hey, Chris, I'm in trouble. I'm in a real estate deal. If I don't get $2 million in 2 weeks, I'm going to lose the project. Help," that sort of thing. So given his entrepreneurial instincts, Chris put together a team of folks that he knew very well, including his exit lawyer for his company, who was a commercial real estate lawyer by trade, a couple of real estate experts he knew, and wanted to find a way to systematically approach these opportunistic situations prudently and be able to protect himself and his capital in the process. Chris funded several of these deals himself out of his own book, had great success, realized there was more demand for his capital than there was at his own disposal to fund it, and wanted to start a fund to scale this up and really meet the need in the market. I had known Chris for many years prior to that, including rooting him on and providing some casual advice through his exit, and then watching as he did these early loans for his own account. We realized the opportunity. He asked me to come join to run investor relations to help raise money and manage our communications with the investment community, which I was thrilled to say yes to, given the strength of this. Our general counsel and chief operating officer was Chris's attorney at his exit, who helped to put these loans together. So the founding team all knows each other well, and there's a reason why this came to be, which is rather a different story than most how asset management companies get started. As I indicated, we're now over a year into this. We have attained some key milestones. Hitting our 1-year anniversary in April is always a big step for any asset manager. We recently completed an audit. We closed our audit report out for our 2023 financials with Deloitte. So we have a blue chip audit report that we can share with people. And we now are pushing $50 million, and with commitments, we have expect to be at $100 million fairly quickly. And our returns to our investors have been exactly what we had expected to be able to produce when we got started. And we'll talk more about that, but it's been an exciting first year, and Paul and Investwise and his investment group have been a key part of that. And thank you for your interest in coming back for a second tranche here. So quick overview on exactly what it is we do. It's a niche market, but it's an extremely profitable niche. We are in special situations, commercial real estate debt. To us, special situations means an opportunity where there's a small to medium-sized property owner who has real wealth and real value in his equity, but has a short-term cash constraint. It could be caused by the need to pay off debt that has matured elsewhere, that they cannot refinance under normal terms in this market, which is a common problem, which we'll talk about. It could be more opportunistic. They may want to add value through a renovation or a rehab and can't get traditional financing for it. There may be an acquisition opportunity that they need more cash for. But the common theme is they all need to access liquidity against the value of their real estate quickly and with confidence. And that's where we can step in. As the slide indicates, we provide opportunistic capital. We can close as quickly as 2 to 3 weeks on a transaction, which compares to a bank where even if you can secure bank financing for real estate right now, which in itself is a challenge, would probably take 3 or 4 months. So our target market is much more focused on the ready availability of capital than they are on the cost of that capital, which gives us a lot of pricing power into this marketplace, as well as a lack of competition, which we'll talk more about. When you put that together on a portfolio basis, and we've now closed 30 loans over the last 13 months, it provides broadly diversified participation in high-yielding, short-term senior secured notes. And we will define our lending box for you, but we sit squarely at the bottom of that capital stack in terms of the risk participation, as Paul described, and allows us to generate a 10% annual preferred return and a target net 17% total return after all fees and expenses to our investors, with senior secured first position debt risk. We'll get more into how we do that exactly, but it is the ideal risk reward combination that Paul referenced. And we are clearly eating our own cooking. Chris has over $1 million of his own assets as a limited partner on the same terms as all of our other investors. And the founding partners all collectively have about $3 million of capital in to support the general partnership. We've built a very robust organization at the outset with the expectation of scaling it up, which we have done. And we all have a lot of capital committed to this. We can scroll forward, please. Am I controlling this, Paul, or do
I
you need
don't
me
think
to?
so. I am, but it's not moving here. There we go.
Okay, there we go. Great. Our ability to provide outsized returns at low risk comes, as any unique return opportunity does, from addressing an inefficiency. And there are a lot of people who will tell you with academic theory certainty that the markets are efficient. I will tell you my personal experiences, they absolutely are not, particularly in smaller niches in the capital markets. There are structural inefficiencies and reasons why capital doesn't always flow freely, notwithstanding what the theoreticians will tell you. And I believe that there are long-term inefficient return opportunities that can be addressed, which is exactly what we are doing here with Spectra. There are inefficiencies for borrowers, which are always there, but particularly true right now with high rates and a tight credit market. It's very difficult for borrowers to be able to access commercial real estate credit, particularly from banks, on anything like normal terms and conditions right now. There's a gigantic hole in the market for lenders willing to fund commercial real estate transactions. We're not doing this solely because it's timely or opportunistic. Chris was doing these loans from his own book 3 and 4 years ago when interest rates were still at zero and the credit markets were wide open. There are always real estate owners who need short-term liquidity. It just happens that this environment is especially good for us right now because of the inefficiency of the broader lending markets. And the reason for that is lenders are also challenged by inefficiencies, especially right now. As everybody knows, commercial banks are incredibly heavily regulated. Their commercial real estate loan portfolios are stuffed full right now. The loans are not repaying, capital's not coming back to the banks. The regulators won't let them lend more. And I don't think this is a disaster scenario we're facing, but I do think the market's going to get worse before it gets better. Banks have not even really had to deal with widespread credit problems yet, which will come as a lot of these loans that were issued 4 and 5 years ago mature and cannot be refinanced and cannot be paid off. So we see the demand for our capital growing, and I fully expect that to continue because of the inefficiencies in the market that lenders are facing. And of course, investors always have a challenge with a lot of market inefficiencies. Where can they deploy capital with what they hope will be low volatility, high absolute return, low correlation, secured types of investments? And that is exactly what we've put together here. And we believe we have solved a major challenge for investors who want that return profile. And we also generate a high level of current income for investors for whom a passive income stream is important. And again, we'll get more into that. We do have a unique position in the market, not only the niche that we're serving, but the company that we built out. Very strong access to deal flow. This slide probably needs to be updated. This goes back a ways. We now are at the point that we have built out the proprietary technology that it describes as pending in the first bullet point. 70% of our deal flow from potential borrowers comes from our digital marketing and SEO expertise. Chris has done this professionally before. We have a chief marketing officer in-house who's very good at this. The SpectraLending.com website allows a potential borrower to click straight through and submit a loan to us within a period of a few minutes. And as everybody probably in this call knows, the algorithms of Google and Facebook, Instagram are so powerful these days that if any property owners ever even thought about borrowing against their real estate, we're able to identify that through our work with these channels, pop an ad right up in front of somebody who's looking for capital. They see Spectra Lending, again, can click straight through and send a lead to us. We are seeing enough deal flow from that channel, allowing us to reach all corners of the country and all types of potential borrowers, that we have only funded 2% of our loan transactions that have been submitted, actually less than that now. So we're able to be extremely choosy, which again gives us a unique position in the market. We are poised to execute. We have our own in-house general counsel. We have 7 very experienced commercial real estate lenders on the team. We control the timing, we control the workflow. It allows us to meet our borrowers' expectation for a quick close. And we're very proud to be able to provide a high level of confidence in closing within a short period of time. And a lot of that's driven by the team we put together. I indicated earlier that we have invested heavily. We have 25 people on our staff right now, which is very large for an alternative asset manager with $50 million of assets. But Chris has built this as though it were a scalable technology company in form. We're not a tech company, but it's a similar model where spend heavily, build it, and then scale it, and the results will be there. And that's exactly what we are fortunate to have seen pan out for us. We are now at the point the general partnership is past break even and beginning to do very well. So we have a healthy and thriving general partnership that allows us to serve the fund and our limited partners with conviction for the future. Next slide, please, Paul. Just a little context about where we fit in the market and how we do this. Broadly speaking, we fit under the umbrella of private credit, which is a very popular topic these days. Some people may have seen the founder of Blackstone, Steve Schwartzman, saying that we're entering a, quote, golden era for private credit. That was about a year ago, and I think that's exactly right. The credit markets are very dislocated. Even in good times, banks are not really serving their borrowers' demands very well. There's more and more need for private, non-regulated, non-bank debt financing. And that's where we step in. And I've raised money for a lot of private credit funds, have been involved in them, areas like litigation finance, merchant cash advance funding. I'm a very big fan of the return profile and the risk characteristics of a well-run private credit fund. It provides an incredibly sustainable and durable, low volatility return profile. And that's what we've done here. We've basically engineered a niche that gives us exposure with a superior participation in the private credit market. And there's similarities to hard money lending, which some people are familiar with. Maybe you've done it yourself, but there's some nuances to what we do that allow us to generate much higher returns with the same risk profile as traditional hard money lending. And I know there's some questions coming in about our lending profile. We'll get to that in just a minute for sure, because that's what really drives our value. Special situations is a unique niche. We tell our potential borrowers, every borrower has a story. There's a reason they're talking to us. Tell us your story and we'll try to solve it. We can be flexible, but we need to stick within certain underwriting guidelines as well. And we'll walk through what those are. So please, Paul, if we could scroll forward. Before we dig into the guts of the strategy and how we generate our returns, it might be helpful just to provide a little profile on where we fit in the real estate market. There's traditional real estate debt, all kinds of different mortgage funds out there. A common characteristic is they use leverage to generate returns. We do not. We don't use any leverage. We do not borrow any money in our fund. We're producing our return stream without borrowing a penny because our gross returns, the rates on the capital we deploy are so high. So we have much better returns without leverage compared to a traditional mortgage fund. And we are broadly diversified both by asset type and by geography. Then you compare us to a syndication. A lot of people have done multifamily syndications or other deals recently. Those also use leverage. They're purely equity, no debt. They are at the top of the capital stack and the risk profile, not the bottom, as Paul indicated earlier. And yet their historical return profile of high teens is comparable exactly to what we're doing. I just have a lot more confidence that our return profile is sustainable than what syndications have seen recently. Higher interest rates have thrown a substantial monkey wrench in the assumptions of these syndication deals, whereas this rate market has been very good for us. And then you look at what we're doing, generating high teen returns, current income, no lockup, first lien position, broadly diversified. We believe it is truly a superior risk-adjusted return. We're in the best part of the real estate capital stack. So here's how we do it. Here are the types of loans that we generate. There are a few common characteristics. Number one, as I mentioned, we are always and always will be senior secured first position lenders. We are never subordinated to anybody else, other than maybe a very rare occasion where we might take a second where we also have the first. But even then, we would also be in the first position, which means that we control the transaction from the debt side. And these are usually simple capital stacks. It's usually our debt and the borrower's equity. We work directly with the borrower's very close relationship and are in control of that position. Secondly, we are low loan to value lenders. Our typical LTV range is 40 to 60%, averaging around 50% compared to a traditional mortgage, which might be at 80%. So we are typically 100% over collateralized on average, both at the deal level and across the entire portfolio, which, as Paul mentioned earlier, gives us a very large margin of safety on every deal we do. There would have to be a massive decline in property value to impair our low loan to value position. Number three, this is short-term debt. It's bridge money. We average 6 to 8 months in maturity. We charge 30% per year interest and fees combined to our borrowers. 2.5% per month is a cost of our capital. It's easy to do some back of the envelope math and realize that's too expensive to be a long-term solution for anybody. We are here to fix a short-term problem or help address a short-term opportunity. We get paid equity-like returns. Our borrowers are always happy to see us show up and close because they want the cash. And then the next day they start working to get us out because we're so expensive. And that is exactly the alignment of interest with our borrowers that we want. And that's what our short-term profile provides to us. Number four, this is also very important. We focus on what we would generously describe as lower middle market, $1 to $5 million transactions. It's an incredibly inefficient market. There's very little competition. That also gives us a lot of pricing power. The hedge funds and large specialty lenders are looking to do 20 or 50 or $100 million deals. They don't want to focus on $1 to $5 million deals. We can only raise and deploy $200 million. We're about a quarter of the way there. That's much too small for the Apollos and the BlackRocks of the world to ever even think about dealing with. So there's no institutional competition to speak of. And at the same time, it's too much money for a borrower who's in short-term trouble to get bailed out by their friends and family. You might get bailed out on a $100,000 or $200,000 problem. You're not going to get bailed out on a $2 million problem by your buddies. That's where we step in with institutional capital, institutional resources in a very underserved market. And then number five, finally, we are willing to lend against almost any type of commercial real estate asset as collateral, except for office space. We are true lenders. We are not loan to own. We're certainly not predatory. We very much want to get repaid by our borrowers. But we also recognize the nature of these deals. Some of these are not going to work out, and we're going to end up having to foreclose as much as we don't want to. And we will end up having to own the property and sell it. So we enter every loan pricing it as though we are going to end up owning that asset and have to sell it out quickly to the market to get our capital back. So we need to know exactly where the price is, where we can clear the market, and we need to know that there's enough liquidity in that market that we can sell a property if we own it. Hence the reason we're not in office right now. But we will do almost anything else. We've done deals in multifamily, retail, self-storage, light industrial, storage and logistics. We looked at hotels. We looked at a mobile home park, almost any kind of commercial real estate that we are confident we can value it. And we've even done some residential assets that have a commercial purpose, like a VRBO rental or a late stage small development. We limit our exposure to that, but we've done some residential type assets too. We don't do any owner occupied single family. We are not interested in lending to homeowners or running the risk of having to foreclose on their houses. Right? I've seen a lot of questions come in about our loan profile. Would it be useful, Paul, to pause a moment and take some questions here, or should we keep going?
Yeah, that'd be great. We can do that. Sure.
Sure. Okay. I'm happy to stop and address some questions, or perhaps if somebody's been tracking the incoming comments and wants to read them, I'll be happy to address them.
I can
Yeah,
do
Pat.
that unless one of the people you've invited wants to. Do you want to do that, Patrick?
Sure. Yeah. There are a lot of similarities in some of these questions. So if I don't address yours individually, we'll definitely lump it into a different question. So we'll start at the top here. So I think this question has mostly been answered, but from an elevator pitch perspective, Brad, How are you able to provide so much higher of a return than your peers? And what additional risk are you taking on to provide that return?
Okay. Yeah, I hope I've at least indirectly addressed that. It really is driven by three factors. Our ability to generate deal flow from places that otherwise would not be seeing these types of services. It's our ability to close quickly and meet our borrowers' demands for ready capital. And then number three, it's a lack of institutional competition. It allows us to price our capital where we basically choose to. And we don't lose deals because somebody's undercutting us by a point or two. If we lose a deal, it's because the borrower found money at 14 or 15%, not 30%, and good for them if they did. But we are able to stick to our pricing grid. We don't take additional risks. I hope I addressed the concept here. First lien, low LTV, heavily over collateralized short-term debt. There are always risks in anything, but that is about as low risk of a lending profile as you can possibly realize in real estate. Again, we only close on less than 2%. We're not for everybody. Everybody's definitely not for us. But if we find a scenario where supply meets demand and we can find commonality, we can close at 30% on our terms, and have done that over 30 times already.
Great. Yeah, it's an awesome answer. Thank you. This is kind of addressed on this slide. What is the average loan amount and duration?
Yeah, average loan amount is $1 to $5 million. And as we keep growing, it's getting towards the higher end of that range. We're focused on $2 to $3 million right now per deal. And average duration, typically 6 to 8 months. We've gone out as long as a year. We had one deal that paid us off in 3 weeks. So short-term bridge type money.
Yeah. And a sort of related question from a allocation perspective, what is the single largest investment allowed in the fund?
Right. Great question. We have an investment policy statement that we wrote before we ever opened our doors, which has concentration limits by property type, by geography, by single loan. So we maintain a broadly diversified stance. Those constraints are generally in the 20% range each. So we can never get over concentrated. And we've had to pass on loans we wanted to do because we already had too much exposure there. And I will tell you that we could fill our fund up several times over with nothing but late stage construction and development loans. There is a lot of demand in that market, but we don't want to be pigeonholed. We limit our development and construction exposure to 25% of the fund. And we'll walk through an example here in just a minute. It's a great area, but we do not want to be known as development lenders. That's not what we're doing. The vast majority of what we lend to are finished assets.
Perfect. Thank you. And I probably should have started with this question. This was asked in various ways 3 times by Glenn, Mario, and HH. Okay. So what is the default rate, basically, of assets that you have to either take over or repossess, and how many have actually paid their loan in full in good standing?
Great question. Now that we're 13 months in, we have real data to work with as opposed to our expectations when we got started. So I'll walk you through that. When we launched, we expected 20 to 30% of our loans would be non-performing at some point, which, a banker would fall out of his chair over that number, but that doesn't concern us at all. In fact, frankly, non-performing loans tend to be more profitable than fully performing loans because we get paid default interest, extension fees, other ways for us to monetize an existing loan. We had one loan that was in default earlier on. It's long since been disposed of, that we were in late stages of taking possession of it. It was actually a sale leaseback. We already owned it. We didn't have to foreclose, but we were preparing to vacate and take possession of the property. The borrower managed to refinance from somebody else and pay us off at the last minute. So good for him. We're sincerely happy he could do that. We had no desire to take his property. But we were prepared to and already had it sold. If we had owned it, it was pre-sold at a level above our basis plus all the accrued interest and fees. But when he paid us off, he had to pay all the default interest and accrued fees. That was a 42% annualized return in about a 7-month period of time on that one transaction, which underscores the point that non-performance doesn't bother us. Having said that, we do want to get paid. Out of the 30 loans that we've originated, we are currently in various stages of foreclosure proceedings with 3 of them. So we are well underneath our expectations. If we're at about 10% right now, we had a tolerance for 20 to 30%. One of them we are extremely close to taking possession of. One of them we've just begun, and the other one we haven't even really initiated foreclosure proceedings. I would guess at least one, if not more than that, will find a way to refi us out and pay us off because When we foreclose on somebody, they give up a lot of equity. That's why we're in at 50% LTVs. We expect to make money when we foreclose on an asset and sell it. We would be happiest if the borrower kept their equity themselves and paid us back. But if they don't, we're in a very good position financially entering these assets at about 50 cents on the dollar. And if we can maintain that rough kind of default, non-performance foreclosure rate, we're content that what we're doing is proper, and our investors will continue to make a lot of money.
Right. I'm tracking 4 more questions here, but I want to hold those until the end because I think some of them will be addressed in the presentation. So I've got Ashish, Mario, Amy, and Glenn pending questions. So we will absolutely circle back on those to the end, but I want to get through the remainder of the presentation first. So I appreciate your patience there. And thank you for the answers, Brad.
Yeah, well, thank you for the questions. I always enjoy hearing what's on people's mind about this. And Patrick, thank you for going through that. Okay, Paul, ready to move forward when you are. Thanks. All right, here's a case study. And we sort of had a question like this earlier, and we hear it a lot. Who in their right mind would pay you 30% for debt money, basically? How are you guys getting that kind of return? Which is a very fair question because they are outsized returns. Here's a great study on how we do it and why it makes sense for everybody. Westover, Alabama. I'm actually based in Birmingham, Alabama. This is where our primary office is. I didn't mention that at the outset, but we have about 15 people here in an office in Birmingham. We have an office on Long Island in New York where our lending team is based. And then we also have a small operation in South Florida and Puerto Rico. This just happens to be near me here in Birmingham, a high growth suburban area. You see the road there at the bottom of that photograph. That's a major thoroughfare where there's a lot of development going on. This particular borrower was basically what they call a land bank operator. He was a very successful developer who would acquire raw land, entitle and improve it up to a certain level, and then had standing contracts to sell it to large national home builders. So it basically provided off-balance sheet land acquisition capabilities for a D.R. Horton or a Pulte Home, somebody like that. Had done it successfully before. He had a lot here, great location, as you can see. 8 units or eight lots he was putting together, had a contract with one of the large national home builders, had a credit facility lined up to allow him to pay for the improvements to qualify to sell the asset. The lender that provided him with the credit facility went bust. So he could no longer draw on his credit facility to pay for the improvements on his house or on the lots so he could execute on the sale contract. He needed $1 million in a quick close to be able literally to install a sewerage system here, which the city would have reimbursed him for, that would have finished off the improvements. We loaned him the $1 million. We took an assignment of the land. We took an assignment of 2 other parcels of raw land nearby. So the LTV was in the low 30s when you count all the assets he pledged to us. And he pledged the assignable sales contract to the home builder. So if he defaulted to us, we could have paid to finish the improvements and sold it off ourselves if we had to foreclose. Great guy, great borrower, did everything he was supposed to do, finished it up, sold his lots for $3 million under the existing sales contract, paid us back our $1 million like clockwork. He made the very rational economic decision. It was worth it to him to close very quickly with us, get his $1 million, pay us about $150,000 in interest and fees over a 6-month period of time, and then be able to go on and monetize his asset for $3 million. And he actually has become a repeat borrower. He loves the quick closes and has come back to us for additional financing after we do them sequentially, pay us off and come back for another one. And he's introduced other borrowers to us too. But that is kind of a case study of why it makes sense for somebody to pay us these high rates. We gave him a shot of liquidity he needed to add value and monetize an asset. He gave us equity-like returns and got us out, and everybody moved on very happily. Happy to answer any questions on that, or we can move on if you'd like. Okay, we'll keep going. Here's a quick
time check. We've got around 10 minutes left of the meeting.
Okay, I'm ready to wrap. We have biographies on our team here, which you can see, and we can make this available. Chris Bruner, whom I mentioned, Craig Lawrence, our COO and General Counsel, Patrick Vertucci, who's based on Long Island, who is our Chief Lending Officer. Then I'm there on the second page, and Jack Krupe, who was part of the original team that advised Chris on how to structure these up for his own account, and now serves on our credit committee. We have 6 people on our credit committee, and it requires unanimous consent of all 6 people to agree to fund a certain loan. So there's substantial checks and balances internally on the portfolio management process. And externally, you can keep scrolling, please, if you'd like to, Paul. Okay, yeah, we'll stop there. That's the rest of the presentation. I'll just mention briefly, in terms of external checks and balances, I mentioned we completed a Deloitte audit recently. We have a third-party fund administrator that monitors our bank accounts, oversees all cash flows, prepares our financial statements, and does all of our performance reporting to our limited partners, including providing an online portal where our investors can log in and see what their individual capital accounts are at any time. So our investors don't have to take our word for it. There's a third party that oversees all this, and then we get it audited. And Paul can attest, he's logged into our reporting portal many times. It does a very good job of providing a snapshot and validating the returns. And we send out monthly investor update notes, which we provide to Paul, and then he in turn provides information to investors. So we keep people apprised of returns and developments every single month. We try hard to be user-friendly and transparent with our investors, and we clearly have an institutional quality infrastructure in place. So I will pause there. Thank you, Paul.
I can vouch for Brad on that. Brad, thank you so much for the presentation. Clear, concise. You're a very strong communicator, as I think everybody here would agree. And as it relates to communication, the entire Spectre team has been phenomenal to work with. You know, when you allocate capital to a sponsor, I think all of us here are experienced in some regard to investing passively as limited partners. Communication is so foundational to the comfort level of what's happening with your money. And we've been very impressed with Spectre's ability to keep us informed. If there's ever a question that we have, we ask and we get a response usually within a couple hours, but definitely no later than 24 hours. So Brad has been a great partner to work with and very flexible with us when we've asked for anything that we've asked for. So thank you, Brad.
Well, thank you. We appreciate your support.
Thank you. And this is the return structure of our deal. As we talked about at the beginning, Investwise Collective is a partner with Spectra, and we are a fund of funds. So we either provide better terms on equity deals that we pass along to our investors. We provide access to our investors in deals that a typical retail check writer like me, myself, Pat, Ryan, our team, where we would write like a $25,000, $50,000 check, we can access these institutional quality deals for lower minimum investments. So that's what we structured here. Our minimum investment to access the Spectra deal is $25,000 versus going direct to Spectra for $250,000. We target a 15% annualized return. Our distributions are paid quarterly. The way we've structured our returns are to pay a 3% quarterly preferred return every quarter, and then we'll take a split of whatever's available above that at 50-50. Those quarterly returns are cumulative and they reset annually based on when the investment is made. This particular tranche funding deadline is June 20th, and the net asset value print for this tranche will be July 1st. So that will be the fiscal calendar for this particular tranche. So for example, when I say cumulative quarterly, let's say theoretically we didn't hit a 3% quarterly return in our first quarter and we hit 2%. That next quarter, we would pay 4% to catch back up and get to 6. And then we would split proceeds 50-50 above that. Spectre's returns to our fund level are a 10% pref and 50-50. So we're implementing this 3% quarterly preferred return and the 50-50 split of the 50-50 that we get. And that's what results in the 15% annualized target AAR. Hopefully that makes sense. There's no lockup provision. The way that we've worked it out with Brad and his team is that if there's an individual investor that would like to extract their capital from our fund level investment, we can do that on a one-off basis. There's a 2% penalty if it's pulled within the first 6 months of the investment, a 1% penalty if it's pulled between 6 and 12 months, and then beyond a year, there's no redemption fee whatsoever. So we really like that from a liquidity standpoint. Like I mentioned towards the beginning of the presentation, refer to it as semi-liquid, and we can potentially redeem these funds and rotate into something more aggressive on the equity side if the market allows us and dictates us to.
Yeah. Paul, may I make a quick comment there real fast?
Please.
On the minimum that you mentioned, that is correct. We do have a $250,000 minimum investment. We stick to that very closely at this point, and we're going to be taking our minimum up to $1 million at some point here in the near future. We don't have a date yet, but that's the direction we're moving. So between the oversight and due diligence you provided on our fund and the ongoing communication, but also the access to investors at smaller levels, that creates a lot of value to come through Investwise.
Absolutely. Thank you for that. And this is just a illustration to highlight targeted projected returns here. It shows the Spectra gross performance on the top line. This is for a $25,000 investment on the top green box, and then a $100,000 investment. So same returns, just different dollar amounts as far as the investment made initially. But it shows the net payout on that investment annualized, and then the net target cash on cash, or AAR. So that's what we are targeting to earn after our fees and our promote split. That's your net as an investor. Lastly, this is a QR code that will take you to our website where you can sign up for our distribution list. You can request a phone call if you'd like to have follow-up and discuss this further. I will take those phone calls. You can also navigate to our website there where you can find our portal. You can sign up in our portal as an investor. You can make a soft commit to this deal. It's all in there. And I would encourage you, if you have additional questions, to please reach out via this vehicle. I'm happy to jump on a call and answer anything that you have on your mind. So we can pause there, and then I'll just say thank you ahead of time for the opportunity, Daniel. If we have any additional questions that we can jam in here for the next few minutes before our hour's up, that'd be great.
Yeah, we've got a couple questions that we want to circle back on, and Brad and I are going through the chat right now trying to answer what we can. So I want to circle back to those folks we skipped a little bit earlier. Brad, I'm going to go with some of the I think simpler questions first in the interest of time, if that's all right. And anything we don't answer, Daniel, if we can work with you to get those questions captured and then address them via email after the fact. I want to make sure everything gets answered here.
Sure.
Just for everybody's sake. So we have a question here about sharing the loan tape. Is that something you'd be willing to do, Brad?
We do make that available under certain circumstances. We can coordinate with Paul and Daniel on what would be most appropriate in this circumstance. But yes, we're happy to provide appropriate transparency to people.
Great, thank you. Follow-up question from Bob. I don't know if we answered how many clients of yours have repaid their loan in full and gone full cycle.
Oh, I did not answer that. My bad. We have had 7 that have repaid us in full. Those, of course, tended to be the earlier loans that we did last spring and summer. We have several more queued up to pay us off here over the next couple of months. So we're seeing a meaningful part of the portfolio now fully cycle and be able to redeploy the capital.
Gotcha. Thank you. And I'm going to try and combine these two. So we have a question from Mario about what is the vetting criteria for the deals. I think that was covered during the presentation, but if there's anything you want to elaborate on, please do so. And related to that, what is the exit strategy after a repossess?
Okay. The second question first is easy. We strive to sell an asset as quickly as we can. We'll typically price at about 80% of actual market value. So we're willing to sell it at a discount to entice a cash buyer to come in and close quickly if we end up owning an asset. And we write to, well, we call it the liquidation value. The loan to liquidation value is really the fundamental internal metric that we write our loans against to make sure we have appropriate coverage on true fire sale pricing where we look to sell it out. In terms of the criteria of the underwriting, real quickly, we write to 3 different considerations. We underwrite to the property, of course, and primarily the value and liquidity of it. Number 2, we underwrite to the borrower, and we're very focused on this. We run FICO scores. We run criminal and litigation background checks. We get personal financial statements, and we get a personal guarantee in every case from at least one of the borrowers from a creditworthy guarantor. And we passed on several loans where the deal looked great, but we just were not comfortable with the borrower. And the third item that we underwrite to is the exit. We want to know before we get in how we're going to get out. We want our borrowers to have a plan to repay us, and we underwrite to that plan. In a lot of cases, we'll talk to potential refi sources or potential buyers of the assets so we can validate that the borrower will be able to get us out as planned. We want to get repaid. I can't stress that enough.
Great, thank you. And then the last one, Daniel, I know we're at time. I apologize. It's from Amy. As a first lien, Will all investors get listed on deed of trust as a promissory, or how do you secure the loan with legal documentation for Spectra?
Right. We do this. There's a much longer answer to that, but we lend to a special purpose vehicle that we set up as the borrower in every case. And then our origination company, Loan Originations LLC, actually funds the loan on behalf of Spectra. So it's all done at an entity level on both the lender and borrower side. And we do perfect all of the security interest properly. We had someone due diligence us and check every single courthouse record and every location we had closed a loan to make sure we had properly filed our liens. And they confirmed that we had in fact done that, which made us feel very good.
I think we got through it.
All right. I wanted to add one additional question that I saw that Ashish asked, and that was more for the Investwise Collective. Are the K1s that you return multi-state K1s? You mentioned that there's a single K1.
It really depends on the investment. Brad, you had something?
Yeah, I'll answer that from the Spectra perspective. I actually jumped in and answered that one on behalf of Investwise. The way we structured our fund, and I can explain this with more time, we do not generate multi-state K1s. All of it flows through one master portfolio account that basically serves as a blocker, totally appropriately, from the need to provide state level K1 reporting, which is a huge benefit for our limited partners. Nobody wants to file several state tax returns. And the way we do this accomplishes that goal.
Right, and that was a consideration for us in our first tranche, and something that we wanted to get clarity on with Brad, and he provided us that. But in future deals, it's just dependent on the deal. But taxes are a consideration as far as just the complexities of making it more difficult for our investors. There are deals that we've had and looked at that we decided to pass on for that very reason. So, deal dependent.
Absolutely. All right. Thank you very much for coming in and presenting to the Alternative Investing Club. Could we have everybody take themselves off mute and thank this group, Investwise Collective, and Brad and Patrick and Paul for coming in?
Hey, thanks, guys.
Thank you.
Thank you so much.
Everyone.
Thanks very much.
Thank you.
Right. That's very kind. Thank you. I appreciate that very much. I enjoyed it.
Also, make sure to grab the link for the Share the Club program and invite 3 people to come. I'll put it in the chat again. Thank you, everyone.
Thanks, Daniel. Bye.
Thanks for the opportunity.
Daniel. Thanks, everyone. Bye-bye.